Hello and welcome. My name's Rick Roller, and tonight we're going to be discussing mortgage loans. That's right. It's going to be an exciting class because you're going to build a team. You see, when you get into real estate, you need to have a group of people around you that are helping you do your business. And one of those people is going to be a great mortgage lender. I started in 1978 as a broker or as an agent, and then became a broker after 1 year. That was in the state of Colorado. Been licensed in several states since then, but there was a period of time when I was running an office, a large office, about 130 agents for one of the largest companies in Utah, and the owner of the company which came in and he said, Rick, I need you to help me. I want to start a mortgage company. And I says, well, uh, I don't like doing loans. I've never done loans. And he says, but I really need you to help me, Rick. And I says, well, and I was one of his managers, running a real estate office, and it was anyway, he twisted my arm, and so I actually got into the mortgage business for a year, or a year and a half or so when he started his mortgage company. And there were about 13 or 14, yeah, a little over a dozen of us that were LOs, loan officers. And I was, had never been a loan officer before. Everybody else in the office had been a loan officer for a number of years. And at the end of the year, I got this. Yeah, it was kind of a dual award. On the one half over here, it said, me. That was night back in 1998, 7, and it says Rookie of the Year. I was the loan officer. I was the Rookie of the Year. But on this side, it was a dual award because I was a top producing loan officer for the whole mortgage company. So it was kind of interesting because not only was I Rookie of the Year, but I was a top producer. I beat all the other LOs, many who had many years of experience. And there's a reason for that. It's because I was promoting, and of course a lot of them had been through the pre-licensing schools and whatnot with me, and so they knew me better, but maybe than some of the others. But uh, my point is, you can do this. That's right. We're going to go through some questions tonight, and you're going to pass the exam because we're going to dig into these questions. And we have a number of these reviews which cover all aspects of the exam. And we would invite you to watch them. Usually they're about 45 minutes to an hour. But we actually talk about questions that bear a striking resemblance to what you're going to see. They're all multiple choice test questions, and we're going to go through. So let's get started in. Tonight we have as our technical guru is Mr. Matt Cliff, who is one of our administrators at our real estate school, the Institute of Real Estate Education. And so we'll be going through those. And we invite you to kind of come along with us on this little journey and work with us. And if you have any questions at any time, you can chat in, and Matt will get those questions, and then we'll get them expressed and we'll get them answered. So let's start with the first question, which is number one. Okay, so which of the following, here we go, which of the following best expresses the mechanics of a mortgage loan transaction? Is it A, the borrower gives the lender a note and a mortgage in exchange for the loan funds? Or is it B, the lender gives the borrower a mortgage and receives a note in exchange for the loan funds? Or perhaps C, the borrower receives a note in exchange for a mortgage from the lender. Now, I don't know if you'd want to receive a loan, but anyway. Or D, the lender gives a borrower a note and loan funds and a mortgage loan. All right. So of all these four, they sound kind of similar and they have kind of the similar terms, but there's only one correct answer. Usually on a multiple choice test like this, you eliminate one or two that couldn't be right. But in this question, the answer is A. Okay. The borrower gives the lender a note. In other words, a note is a promise to pay, and like a promissory note. And so, the borrower signs that promissory note, but that's not enough for the lender. They're not going to lend you $500,000 or 400,000 or whatever your loan's going to be on just a signature loan. They want some collateral. And so they tie that note with a mortgage type document in exchange for the loan funds. Now, on the test, a question would appear like this, and they're not going to make much difference between, or they're not going to really distinguish that much between a mortgage or a trust deed. Okay. But in most states, just very few have mortgage only states. And those states like Wyoming that have that type of a situation, they have very well set out uh, procedures on how the mortgage will be foreclosed. Okay, because in our state of Utah, if they are foreclosing on a mortgage, that's a court foreclosure. And no lender wants to go to court. I mean, there's going to be a bleeding heart judge there. You don't know what they're going to rule. you know, so they want to stay out of the court. They want an administrative type foreclosure. And so in our state, instead of a mortgage, that you could have a mortgage in Utah, but no self-respecting lender is going to give you one. They're going to give you a trust deed because trust deeds are foreclosed outside of the legal judicial system. It's just an administrative type foreclosure, and they don't have to get in front of a judge if they need to foreclose. And so that's why you're going to get a trust deed. But they're not going to distinguish that because really this is a national based question. Okay. And so they're going to call it a mortgage here. But the correct answer is that the borrower gives the lender a note and they also sign a mortgage, which ties that note to the collateral, which is the real estate. Okay. So that's the answer to number one. Answer A is the most correct of all those. Number two.
Hey, hope you're enjoying the video. Be sure to like and subscribe so you don't miss any more of them. And if you want even more review material, we have in the Prep My Exam link in the comments, we've got a plethora of practice exams, we have audiobooks, we have an exam simulator, we have everything that our students use to pass the exam on their first try. Okay? And if you want to get licensed in Utah, check out realestateonlinelearning.com and we'll hook you up.
Number two, that's good. Mortgage loans typically call for the payment of loan interest, A, in advance, B, after 1/12 the annual principal is paid, C, annually, or D, in arrears. Now, this one, arrears means you're paying for the month that was, and that is the correct answer. You pay for the month that was. Okay, so there's only one time that your buyer is going to pay mortgage interest in advance, and that's when they first do the loan. So a lot of agents get into the habit of closing towards the end of the month. In fact, a lot of them like to close the last 4 or 5 days of the month because there'll be prepaid interest. So what happens is if you're closing on let's say you're closing on the 20th and there's 30 days, you're before the end of the month. So that'll be the only time when they fund that loan that you'll pay 10 days of prepaid interest. And then after that, you'll make your monthly payment. You're paying the prepaid interest for that month. Let's say the month was any month with 30 days in it, and then there will be no mortgage payment until the month after. So you'll go through that whole month, and there'll be a prepaid interest between now and the end of the month, but your first payment won't start until another month after that. So because you're paying it in arrears. Mortgage payments, the interest is paid in arrears. You're paying for the month that was. And a little bit of that, of course, goes to the principal balance, but that's not that much. Most of your payment, for at least the first 8 or 9 or 10 years of a loan is going to be the interest. And then as that loan pays down, of course, more and more of that fixed amortized loan, that fixed payment that you're paying over a period of years, as your loan actually goes a little bit more, a little bit more, a little bit paid off, then more and more of that monthly payment goes towards the principal. But most people move in 5 or 6 years or so, and so they never really get much paid on the amortization of a loan because that's just the way it's rigged. And you've probably seen an amortization table, which you're going to need a great calculator, and this is the one most of us use. It's an HP12C, and it's because this one will actually do amortization. We'll figure out what payments are, but you can't use one of these fancy calculators on the test. You can only use a cheapie that only does multiplication, addition, subtraction, and division. That's it. These fancier calculators have the Elwood tables program into them, which allows you to actually figure out loan payments. But you can't take one of these exam. You got to take an El Cheapo, and something you can pick up probably for less than $10 or something somewhere. And truth be told, there's actually some calculators you can use there, and there's one calculator that you can actually use on the computer program itself. But that's difficult to look, this is a timed exam, okay, and you're going to be under some pressure, and so it's best to have a calculator that you can kind of punch the buttons and just get that done without moving to a different screen and then moving back to the question and then moving the screen, moving back to the question. That's just cumbersome. So take a cheap calculator. Don't take anything that has amortization on it. They're going to want to look at it, and they have a few there that they could probably lend you, but don't count on it. Okay, let's go to number 3, please. If a lender was charged with a usury violation, which of the following circumstances would have occurred? Usury is excessive interest rates, okay? And so with that, you're going to get it. It's A, the lender charged an excessive rate. Now, the state would have to have a usury cutoff point in order to do that. In our state of Utah, of course, this is a national question, but our state in Utah, we don't have a usury limit, so it's going to be hard to convict someone of usury here. What's the matter with B? The lender included terms and conditions in the loan agreement that were improper. That has nothing to do with usury. Usury is just excessive interest, period. You're not going to get a lender that's going to give you a improper or anything that's not prima facie, anything that would violate any state laws. In fact, the loan documents that they use are nationally approved documents because most loans are not going to be kept by a lender. They're going to be sold in the secondary money market, which, that's a different class, but understand that. C, the borrower agrees to pay both loan discount points and the origination fee. Well, that has nothing to do with usury. That's just a normal thing that you have to pay. If you want a little lower interest rate or maybe a rate that's bought down a little bit for the first few years, you're going to pay some discount points on that. And then, of course, origination fees, that's just how a lender makes their money. And then D, the term of the loan exceeds federal guidelines. There is no real term of the loan that exceeds federal guidelines. If they want to sell it in the secondary market, they're all going to be somewhat the same. Okay. So they're not going to have loans that exceed federal guidelines. They're going to, everything's going to be within the federal guidelines because all lenders are selling their loans for the most part. Very, very rare that a lender actually lends their own money and then warehouses that loan. Most of them sell their loans in the secondary money market. And then the servicing is also sold as well. So, but let's go to number 4. Mortgage or trustee documents are typically regulated by the blank, federal, state, county, or city. Well, you can eliminate county and city. Okay. It's got to be federal or state. Okay. Well, and like I've already hinted before, this is mandated by state, but it's sold according to federal guidelines because they don't want to warehouse these loans. They want to sell them. That's how they make their money. They put loans together, they make money up front. Sometimes the lender will sell loans and then maintain the servicing because that's quite lucrative as well. So the servicing could be sold, the loan could be sold, and sometimes they split that up. Sometimes the originating lender keeps the servicing because they're prepared to do that. And sometimes they sell both of those. And there's all types of companies that want to buy the servicing, but not the loan, and other companies that want to buy both, and others that just buy the loan and then sell it again to Fannie Mae. Let's go to 5, please. The borrower just closed a loan with ABC lender. In the email, she's received notice that the contractor was not paid after completing repairs in the borrower's recently purchased home. Ooh, that's nasty. The notice states that a lien's been filed against a borrower's property. Which of the statements is correct? Well, lenders don't want this to happen, of course, and that's why there's 2 title policies that are issued in a normal transaction. One title policy is issued where the seller has made promises to the borrower, the buyer, and another's is a policy that's given that the buyer actually pays for, that ensures to the the to the bar to the lender they're borrowing the loan, they're getting the loan from, that loan will be in first position. So you've got two title policies that could come to play on this. But number five, the correct answer is going to be B. Okay, the lender, due to the risk in losing their collateral position, will place the borrower on a default notice. And of course, the borrower then has title insurance that was paid for, a policy. It was paid for by them. Well, no, it was paid for by the seller, guaranteeing to the buyer, or as that the borrower got good title. But there's also another policy that the buyer bought for their lender. So there's two policies out there, and normally what they'll do is they'll go to work and take care of this problem, and then they're going to go after the um, whoever placed that lien, and and it wasn't picked up. But this is probably not going to happen, because the title policy was, um, the insurance company that did that, the title insurance policy, was very meticulously um, done. It was very meticulously examined and whatnot. But there could be a situation where something popped up that came after, for immediate repairs, like it said in our question here, or a contractor was not paid and it was a very recent thing, and so it didn't really show up on the records till later. But it's going to be taken care of by the insurance company. Then they're going to go after the guilty party one way or another. Okay. All right, let's look at number 6, please. So no worries, that's what you got title insurance for, and they'll take it to court if they have to. But usually they don't. Now, number 6, the alienation clause states that, in this case, is it A, the borrower must always maintain citizenship, or at least legal alien status, so as long as the mortgage exists? No, no. What about B, if the property is transferred to another by deed, the mortgage becomes due and payable immediately? That's exactly what it is. That's correct answer. If you alienate yourself from title, there is a clause in the loan documents that you signed that said you wouldn't do that without paying the lender off. Now, most loans are assumable, but they have to be assumed by the buyer with credit qualification. So if you are selling your home and they want to, take over that loan, it has to be approved by the lender. Now, see, if the joint owners divorce, the court will require payment in full of the mortgage as a condition. No, that's not true. They both signed on it, and probably one of them, who is not getting the property, is going to want to get that paid off, but it doesn't necessarily have to be paid off. Indeed, after sending a timely default notice for missed payments, the lender can accelerate all payments, calling a loan due. They can always do that. That's not what our question's all about. That's not what the alienation clause is. Alienation is pushing yourself, when you alienate someone, bad breath or bad manners or just pushing them away, that's what you're doing here. You're pushing your way of self, to letting someone else assume that loan without credit qualification. Like I said, most loans are assumable, and there's a lot of them out there that have really great interest rates, which are fixed and will not necessarily go up. So as we enter into a higher interest rate market, a lot of these existing properties, there are buyers that have sufficient equities to buy down to that loan. But it's going to take credit qualification. Okay. You can't just do it with some paperwork and not let the lender know, because of the alienation clause. You promised them when you got that loan that you wouldn't do that. You wouldn't just let someone take it over without them being notified and having a chance to decide whether they wanted to work with that borrower or not. Okay, so it takes credit qualification. Okay, so let's go to number 7, please. Okay, number 7 says, when the terms of a mortgage loan are satisfied, the mortgagee. Now, mortgagee, mortgagor. Okay. Who do you think the mortgagee is? And by the way, if you have questions, put them in the chat, and we'll get them answered. But the correct answer to the number 7 is D. It may be required to execute a release of the loan document. Okay, so if the terms of the mortgage are satisfied, it means it's been paid off. Well, don't you think the lender, I mean, who is the mortgagee? It's the lender. Okay, the mortgagor is the person that allowed that loan to be put on their property. When you're buying a house, there is a process and a protocol on what timing of the documents has to happen. You cannot borrow money on a property you don't own. Okay, so the first thing that's recorded in the buyer's name is the title of the property. And then the second thing that's recorded is the loan document, because you couldn't reverse that because it's not your property until it is. Okay. So you can't borrow money on that property until it's yours. Okay. And so they record the title in your name, and then they record immediately, nanoseconds after that, they record their mortgage loan. And of course, the title company is going to make sure that the correct order of that is done. But eventually, we want to also record a release of mortgage of that old loan. Okay. So the title company will escrow the amount of money that the old lender said was necessary to pay that seller's loan off. And they keep that money in escrow. And so they get a payoff notification from the lender on here's what we'll accept to pay that off. It's calculated down to the penny. And then the title company sends that to the lender, and then the old lender, and then that old lender then will send a release on that mortgage document. Okay, it's called a deed of reconveyance, and that's the document. It has to be recorded in a public record showing that old loan is paid off. But it's not going to be sent out by that old lender until they have their what? Until they have their money. So, that's why these things are put into an escrow, and that's, it's a title company handles that, and they're regulated in Utah by the insurance department, and they're licensed and they're bonded, and so there has to be this intermediary that collects all the money, makes sure everything's calculated down to the penny, and then sends that mortgage payment out immediately to the old lender. And once they get that, now they say, okay, they've also sent them that deed of reconveyance, and they sign that and send it back. Okay. Now, which brings up a point here. It makes a lot of sense to order title commitments early in a transaction. Now, I know a lot of agents don't like to do that because they're afraid there'd be a cancellation fee if there's no loan or if there's no transfer that ever occurs. And so, and that could be a couple of $100s. Well, in most of our listing agreements that we use, there is no state approved listing agreement, but we use one that the Board of Realtors has put together, or some companies, some brokers have actually written their own or had their attorneys prepare their own listing contracts, or maybe modified the board form a little bit so it, to their liking. And so when a seller signs that, it says that if there is no sale, and if we order a title commitment early before finding a buyer, then if there is a cancellation fee, the seller agrees to pay that. And that makes sense. And why would we do that? Because sometimes they find things on the title commitment, little problems that have to be taken care of. And there was a property I listed on 39th South and 20-something East one time. The lady that owned that property, when she bought it, she had assumed the first mortgage and had the sellers carry back a little second mortgage, which over the years she'd paid off. And when she paid it off, her not really having much experience in real estate, and of course the old seller that had been receiving payments and had received what they were owed, all they did was send her back a copy of the promissory note that they had received when she signed that, when she bought the property. And they wrote on there paid in full and sent that to her. They didn't know there's going to be a document called a deed of reconveyance. So, they thought it was fine. But when I listed the property, I ordered an early title commitment. We found out that old mortgage, or actually it was a trust deed, had not been paid off. Well, the problem was, I mean, how many sellers keep in touch with their buyers? I mean, it's years later, and so, hey, we're moving to Florida now. If you ever need us, here's where we can be found. They don't do that. So we didn't know where the seller was, so we had to order we got a skip tracer to actually come in and rescue us, and they have all kinds of resources for tracking people down, and they tracked these sellers down. I got a hold of them and I said, here's what happened. You didn't sign all the documents necessary to release that loan. Oh, geez, we didn't know that. Got it out to them immediately. They signed it in front of a notary. They sent it back, and we took care of this before it became a problem. Now, there's all kinds of horrible things that could have happened if I would have waited, until we found a buyer, and now the buyer wants to close, and maybe the buyer's got their loan approved, but that loan approval is only for a week or two or three, or where they've locked the rate in. Rates have gone up since then. And so, this never became a problem because we handled it in advance. We handle it in advance. Okay. So a smart agent does their research on it properly early on. And one of those things is that I order a title commitment. So, you know, I tell the seller, well, start packing, I'm on the job. Your house will be sold. Okay. So this is just one of the things you want to think about, in the practice of real estate. But for the test, okay, when the loan's satisfied, okay, and it will probably be a trust deed, not a mortgage, but the test may not distinguish that. Uh, Someone is going to be required to execute a release of that mortgage document, and that's going to be the lender. That's going to be a deed of reconveyance, and that's just going to be handled. That's one of the things the title company handles. But in this case, when we found out early on it was there, and we had to track these people down, and we got it all handled. So it was never an issue. It was never an issue. In fact, the lady was pretty impressed. She decided to get into real estate, the seller, and that I had listed it with, and she's become legendary. I mean, my gosh, it was my privilege to help her get started, and I she's been the most successful agent I've ever trained. Millions and millions of dollars. Actually, I mean, she called me recently and said, Rick, I'm about ready to retire. I think I'll do another maybe 8 million in sales this year, and then I'm going to quit. Wow, she was amazing. Number 8, please. Okay, number 8 talks about the ECOA, the Equal Credit Opportunity Act, with federal law, and it requires lender to do certain things. Okay, and what is it that they require it to do? Is it to extend equal credit to all prospective borrowers? No, because some prospective borrowers may not qualify, or perhaps it's B. Consider the income of the spouse in evaluating a family's credit worthiness. Now, in our country, there was a period of time when lenders were reticent to lend in using maybe the wife's income, because, well, she could become pregnant, and then how do we know she's going to continue to work or something, and so, but ECOA says no, 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 you can't discriminate on that type of thing, sex or gender. And so what we're looking at here is B is the correct answer. C, discount the income of a person involved in child rearing. Yeah, well, no, that's what ECOA says you can't do. And then D, specialized lending activity by geographic area. Well, we don't lend in that area because all them people live there. We only like to lend in this area where, the nice people live, so can't do that either. So ECOA, this is what it does. The spouse, regardless of their gender, has to be, if they want to be on the loan and you need them to qualify for the loan, that's fine. Even if they might become pregnant sometime in the future. Number 9, which is the best description of debt to income ratio? When lenders are doing loans, you have to evaluate whether they can afford it or not. And so they have guidelines on debt to income ratio. And like I said, you need a good lending partner that can help you put deals together. There's all kinds of special things that come out once in a while, and sometimes it's done by a city. Provo City is very aggressive in getting monies put together and the coming out a special deal where if you buy a home in Provo, you can receive up to a $10,000 grant, in order to help you buy that home. I mean, it's really cool what some cities, what some counties can do, but it's your lender that's going to get wind of those. And the problem with those programs is they only have a limited amount of money. So the first, 50 borrowers that get in there, they're going to drain that out. And so, having a lender that, has their ear to the ground and knows what's coming up can be extremely valuable to you because you can make deals based on special programs that they got a kind of a head start on, got wind of. It's real important, okay? But this debt to income ratio is fairly standard, because they're trying to meet federal guidelines. So the correct answer to number 9, folks, is going to be A, a percentage representing the relationship of the total contract debt to gross income, okay? Now, what's wrong with B? A percentage represents the mortgage payment, including PITI, mortgage insurance, and HOA compared to gross income. Usually they don't calculate homeowners association fees into the loan qualification process. The other things are good, but not HOA. C, a percentage representing the relationship between the total contract debt after tax. They don't calculate tax income or income tax in loan qualification either. D, a percentage representing all monthly budget payments. Well, monthly budget payments could be lots of things, okay? That they don't necessarily calculate everything in. The correct answer of these 4 is a percentage representing the total relationship of the total contract debt to gross income. Okay? Okay, cool. Number 10. Number 10 talks about loan to value ratio is an important underwriting criterion. The primary reason that A, borrowers with no equity will defeat and abandon the property. I don't know. B, the lender wants to ensure the loan is fully collateralized. And that is correct answer. B is the correct answer. Okay. A borrower can only afford to borrow a portion. Yeah, well, that's usually true, but then they have equity put down. A fair amount of borrower equity demonstrates good faith. Good faith. No. B is their correct answer here. They want to, that the thing is collateralized correctly. And they get an appraisal to help them figure that out, and the down payment and everything else. Look at number 11, please. When a lender confirms a specific loan amount and agrees to the interest rate, this process is called a lock. You lock that in place, and they usually give you that just period of time. And after, there's a deadline on that, you got to close. That's why cleaning up the problems on the property title early on is so important. It's not a disclosure, it's not an origination fee, and it's not interest insurance. I don't even know what interest insurance is. Number 12, please. Let's talk about truth in lending, or Reg Z. Truth in lending is also called Reg Z. It includes all the following requirements except okay, they do, Reg Z is where APR comes from. APR is always the same as or higher than the nominal rate, the face rate on the loan. Okay. So that's good. That is, you see that word except, it's all caps. We're looking for the thing that doesn't work. Advertising restrictions, definitely part of truth in lending. Settlement cost in you is a little booklet they used to give out, but now they use something called disclosure of costs. So the C is an old term, and that's the one that doesn't really apply anymore. And that was number 12. Okay, moving along now, let's look at number 13. The lender's just taken the application for a home loan from Jan and Bill. How long after the application date does the lender have in order to provide Jan and Bill with the truth in lending disclosure? Is it 1, 3, 5, or 10 days? Well, what do you think, guys? It's got to be pretty prompt. 1 day is pretty dang quick. 10 days is way too long. So it's either 3 or 5. What do you think, gang? Well, based on some of the other things we've seen, you know, what would your guess be? If you're guessing 3 days, you're an excellent guesser. It's 3 days. Look at number 14, please. The Fed regulates the money supply in which of the following ways? Okay, they have a lot of things they do, but B is the correct answer here. They buy securities, they change the discount rate, and they control banking reserves. Okay, so by manipulating these, they can manipulate the money supply by loosening up the reserves the bank has to have. They have more money to lend. Okay, so uh, the others don't work. There's just too many other things in there that they don't do. This is the correct answer. So go for this when you see it. Number 15, please. A borrower wants to qualify for an FHA to insure their loan. FHAs are insured, VAs are guaranteed. Which of the following would disqualify them from an FHA loan? No down payment? Yep, that's the one. Average credit score? Well, I don't know what you mean by average credit score. Low debt to ratio income? Man, they like low debt to ratio income. I mean, if you have no debts, I mean, you might be golden getting a loan. I mean, low debt to ratio is a good thing. And shared bank account. Well, a lot of people have shared bank accounts. Most married people do. Okay, let's look at number 16, please. Here we go. The maximum loan of value ratio on a VA loan is which of the following? VAs, you can borrow all the money. It's not 90, not 95, not 96.5. It's 100%. Veterans have benefits. You put on a uniform and you protect our country, and you served, and there's benefits for that. And one of the benefits is that you can get a full ride loan 100% down. And that's good for single families. It's also good for duplexes, triplexes, and fourplexes. In my first year in the business, I sold a fourplex to a gentleman that was renting, but he had a VA. He had no idea that all I had to come up with was some closing costs, some of which that he had to pay, but some of it could also be paid by the seller as well. And those guidelines change a little bit from time to time. This is why you need a good lender who's going to help you keep apprised of these programs and what the current changes are. Number 17. Oh boy. Which cost must be disclosed during the closing disclosure? Okay. Well, um, what do you think? We can hide some and not hide others. The borrower's cost, the seller's cost, the broker's cost, you know, all the costs must be disclosed, guys. I mean, come on. Um, you can't hide things. That's what the closing disclosure is for, so they can kind of see what it's going to take to make this deal work. Some costs can be paid by the seller, to help the borrower get in, but that's not what this question is. It just says what can be disclosed on that closing disclosure, all the cost. That makes sense. Number 18. Here we go. All right. How many days before closing must the seller view the closing disclosure? Okay. Now, the problem with this question is the seller's not getting a loan. Who's getting the loan? The borrower. Okay. The buyer. So it's the buyer, not the seller, that must receive the closing disclosure at least how many days? 3 days. We already covered that. Okay. But that's not the right answer. It's the seller doesn't get I mean, they get a settlement statement, but the closing disclosure refers to all the costs, including the loan. Well, folks, that's our 18 questions for tonight. My name is Rick Roller, and my number 801-556-8000. That's 801-556-8000. That is my secret cell phone number. So if you have any questions, happy to answer them. Does anyone have any questions tonight that we can cover? Speak up, Erica, or others. We have several others here. Amy's here too. And okay. Well, give me a call on my personal secret cell phone number if you need help, although it's considered totally inappropriate to call me during the exam itself. Oh, I know I could be the most help to you then, but going to get us both in a lot of trouble. So don't call then. Call before, if you have a question on the material. And I'm serious about that. I get about 5 or 6 calls a week or so. I'd much rather you gave me a call and you're stuck on something, you can't quite find the answer in any of your textbooks or whatever. We'll spend a quality 3, 4, 5, 6, 10 minutes on the phone, whatever it takes, and you'll understand it. And that's a lot better than trying to go through all the different booklets you've received and textbooks that you've got. Sometimes questions can be answered quite quickly, and I can take care of that confusion. This is part of what the tuition goes for. I mean, so appreciate you being here tonight. We have a number of these videos, and you can find them on the Institute's website. And I hope that it's been helpful to you. And we cover all the topics, including Utah law. So have a good night, if it is night, or whatever time you're watching this. And remember, you can do this. You can pass this exam, and you can also make it in this business. We need good people. So come on ahead and let's get you licensed and get you going. Thanks for joining us tonight.
Thanks for watching. If you want to show some appreciation to our instructors, be sure to like and subscribe so that they see how much you enjoyed it. And if you want any additional review material, check the links below for our full suite of practice materials for the real estate license exam. Thank you.